Right now, an invisible thief is standing inside your brokerage account, quietly draining your financial power while you sleep. Throughout human history, the exact same pattern repeats. Empires print money, paper wealth skyrockets, and ordinary citizens celebrate an illusion of prosperity. But history reveals a darker truth. Today, in July 2026, the American dollar index is surging over 101. Gold has experienced a dramatic institutional flush below $4,000, and the stock market is riding an extreme tech high. Why does this matter to you right now? Because your purchasing power is being crushed by sticky inflation. If you do not understand the hidden seasonal shifts of the global economy, you are walking straight into a wealth trap. Here's your practical guide to wealth preservation and asset allocation. What is a business cycle? Let's simplify what a business cycle actually is. Do not listen to hard academic jargon. Think of the global economy as a regular calendar year with 4 distinct seasons. It moves from spring, which is early expansion, to summer, which is peak growth. Then it transitions to autumn, which is a late cycle slowdown, and finally to winter, which is a recession or market reset. This cycle is driven by the availability of credit, corporate profit margins, and employment levels. The economy cannot move in a straight line upward forever. Just like nature, it must breathe. It expands when credit is cheap and contracts when debt becomes too expensive. Understanding which economic season you are living in is the single most important rule for protecting your household wealth. How do we know which economic season we are in right now? We measure the speed of economic growth, not just the raw stock prices. We look at whether inflation, interest rates, and factory outputs are accelerating or rolling over. To prove we are deep in a late cycle autumn transitioning to winter, we look at the famous copper to gold ratio. Copper is the worker drone of the world. It builds houses, cars, and factories. Gold is the guardian. It protects wealth during a panic. Right now, copper prices are dropping because global manufacturing is slowing down, while gold remains historically elevated. When the worker metal falls and the guardian asset shines, the economic dashboard proves the air is turning cold. The yield curve, when short-term government bond yields pay higher returns than long-term yields, it proves the credit market is pricing in an economic breakdown. The American dollar index, a DXY rising above 101, proves global liquidity is tightening as capital rushes into cash safe havens. You may ask, what is the proof and indications? Listen carefully. I have already mentioned 2 indications. These are 2 undeniable proofs confirming our current position. First, look at the American dollar index, known as the DXY, holding strong above 101. In a normal growth environment, capital spreads out across the globe. But in a late cycle slowdown, the Federal Reserve holds interest rates high to battle sticky inflation. This acts like a giant global vacuum cleaner, sucking liquidity out of international markets and dragging it back to America. Second, look at the yield curve. When short-term government bonds pay higher returns than long-term bonds, the credit market is shouting a warning. The smart money is screaming that the near-term economic foundation is highly fractured, even if technology stocks are temporarily ignoring the data. Can the business cycle go backwards? Is it possible for the business cycle to go backwards? Can the Federal Reserve printing trillions of dollars or massive artificial intelligence profits from semiconductor companies reverse the cycle back to spring? The short answer is no. The cycle cannot move backwards, but it can be artificially stretched and delayed. When central banks inject massive liquidity or when tech giants experience a hardware infrastructure supercycle, it acts like a massive shot of economic adrenaline. Listen closely. This is the single best-kept Wall Street secret that nobody knows except the insiders themselves. Imagine you live in a town where the local bank prints millions of tickets called Fed bucks. You think the tickets should be worthless. But there is a catch. The bank has forced every store, every factory, and every citizen in the town to take out massive loans that can only be paid back using those exact Fed bucks. Even though the bank is printing them, the entire town is in a frantic panic every single day to hunt down those tickets just to pay off their debts and survive. This is the global economy. Over 80% of global trade and trillions of dollars in international debt are written strictly in US dollars. When the global economy slows down in a late business cycle, countries and massive banks don't care that America printed money. They are trapped. They desperately need American dollars to pay their bills, creating a global dollar shortage. That forces the DXY straight up. It keeps the late cycle autumn phase alive for months longer than normal. This causes a vertical, speculative stock market melt-up. However, this does not cure the economy. It creates stagflation, making the eventual winter transition much sharper and more volatile. You may ask, if the business cycle is so obvious, how come expert Wall Street fund managers with billions of dollars under their management don't predict their liquidity problems earlier? The truth is, they are structurally trapped by their own business model. It is driven by career risk. A fund manager has officially decided on short-term performance against their peers every single quarter. If a manager moves into safe cash early to protect capital, and tech stocks jump another 30% on pure hype, they will get fired by their clients for underperforming. Fund managers are forced to keep dancing even when they know the music is about to stop. They operate under the illusion that they can escape through a narrow exit door right before the crash. But liquidity always evaporates instantly when panic hits. Every fund manager believes they are smart enough to sell their shares right before the crash. But because institutional funds hold billions of dollars in stock, they cannot all exit through a narrow door at the same time without crashing the price. When panic hits, their liquidity evaporates instantly. Here is a critical question about the business cycle that most retail investors completely miss. What is the lag time of central bank actions? When a central bank raises interest rates, the real-world economic pain does not hit the market the next morning. It takes roughly 12 to 18 months for higher borrowing costs to ripple through corporate balance sheets and everyday households. This massive lag time is the exact reason why the stock market can reach record highs today, while small businesses and consumer credit limits are quietly breaking behind the scenes. The market behaves like a large ship. You can turn the wheel today, but it takes a long time for the entire vessel to change direction. The lag is running out. Just remember, the bottom of the cycle occurs when the Federal Reserve aggressively cuts interest rates. The DXY drops sharply, and industrial commodities like copper begin to outperform gold. This is the ultimate green light signal to deploy cash back into growth assets. Another hidden force in this cycle phase is called the wealth effect. In the final stages of an economic expansion, home prices and a few elite mega-cap technology stocks stay artificially high. Because everyday people see their home equity or superannuation balances looking green on paper, they feel rich. This psychological illusion causes them to keep spending money and taking on high-interest credit card debt, completely ignoring the macroeconomic warnings. This behavior masks the underlying structural slowdown, creating a false sense of stability. The retail public continues to consume at peak levels right up until their credit limits are reached or corporate layoffs begin, causing an abrupt and painful awakening when the season shifts.
This video is for educational and entertainment purposes only. It is not financial advice. Always do your own research and consider seeking professional advice before making financial decisions.
Okay, now I answer this question that everyone is waiting for. Why are gold and silver prices dropping right now if we are in a dangerous late business cycle? Global gold has flushed below $4,000 because of a hidden Wall Street emergency called a margin call. To understand a margin call, imagine you buy a house worth $1 million. You put down $100,000 of your own cash, and you borrow $900,000 from the bank. If the housing market drops, your house value crashes to $850,000. The bank panics. They call you and say, "Your house is worth less than the loan we gave you. Put $50,000 cash into your account by tomorrow morning, or we will seize your home." This is exactly what is happening to big hedge funds. They borrowed billions to buy tech stocks. Now that tech is cracking, the banks are demanding immediate cash. To get that quick cash and save their businesses, these funds are legally forced to liquidate their best asset, gold. This forced dump creates an artificial price drop, providing an incredible discount for patient retail investors. Let's now address digital assets like Bitcoin, Ethereum, and crypto ETFs in brief. But I promise you in future videos explain more. In a late-cycle growth trap, cryptocurrencies behave like hypergrowth technology stocks on steroids. They rely entirely on massive global liquidity expansion. With the DXY strong and global yields high, that liquidity is actively shrinking. If you are holding profits in smaller speculative altcoins, the smartest move is selling them completely because they carry zero late-cycle defensive value. For crypto ETFs on the stock market, beware of the ongoing management fee drag and lack of weekend liquidity. Sell these paper versions and move the proceeds into your high-yield cash accounts or mortgage offsets, where your wealth is legally protected from a systemic tech sector unwinding. How can a retail investor or ordinary person spot the exact inflection point when economic winter ends and spring begins? You must watch for 3 clear signals on your macro dashboard. First, the Federal Reserve will aggressively pivot and slash interest rates to combat rising unemployment. Second, the American dollar index will experience a sharp, sustained breakdown below 100. Finally, as I have mentioned before, industrial commodities like copper will begin to aggressively outperform gold on your daily charts. When you see copper rising while the dollar falls, it proves factories are restarting and real economic demand has returned. This is your absolute green light to take your cash out of defense and deploy it back into growth assets.
In conclusion, the mixed signals of today's market are a classic late-cycle illusion. The stock market looks high because of extreme concentration, while precious metals are experiencing a temporary liquidity flush. By protecting your core capital inside a high-yield offset or cash account, you are executing the ultimate winning strategy. We will wait patiently for real value to return before striking. If you found this video valuable, subscribe to the channel, hit the like button, and join us as we continue uncovering the hidden forces shaping our economy and our financial future. Until next time, take care of yourself, keep learning, and keep asking questions. Thanks for watching.